Good morning, everybody. It is Friday the 13th. Ooh, scary. This is the Morning Blast. You join myself, Ryan, and of course, Mike, for a very candid market podcast. We look back at what happened the previous day, what to look forward to on the upcoming day, etc. Put some value into your day, put a smile on your face, etc., etc. One thing I will say about Friday the 13th, as my good friend Polemic Payne told me this morning on WhatsApp, it's basically a 1 in 7, chance in terms of, it's on average happens once every 7 months, which is more likely than this month being February. So I don't know why people get too upset about it, but there we go. Michael, how are we?
Well, a very good morning to you, Ryan. Good morning, everyone. Very happy Friday. We have made it to the end of what's been a slightly chaotic week, but nonetheless, things are starting to look up as we look forward to the weekend. And hopefully nothing breaks on what could be a spooky day.
Oh, God. Sorry, I am tired.
Are you all right there? Were you out last night, Ryan?
No, I wasn't. I wasn't at all. I think that's it. I think that's the problem. I think just too much sleep. So there you go.
It's a nice problem to have. I wouldn't know, but
well, that's because you're an alcoholic.
No, it's because I just wake up at a stupidly early hour.
Yeah, okay. Yeah, right. When he kicks you out of bed, okay, right.
Right. Well, I'm not even going to go.
Moving on.
Just reminded me of that conversation we were just having.
What about me being big spoon to your little spoon? There you go. Right, let's get back on track. It is Friday, and the wheels have already fallen off the wagon. More ways than one. Market update from our good friend Clive Lambert over at Futures Tech. So Clive with the levels to watch, etc. Obviously, being Friday the 13th and everyone getting a bit frothy knickers over that, he's asking, will it be a nightmare on Wall Street? Maybe, maybe not. But I think just buy the dip as usual. S&P saw red yesterday and is back at 68.45. Short-term Fibonacci level we've been watching of late. On this side of the ditch, the DAX posted a shooting star after falling just shy of the gap resistance at 25.322. High was 25.310. So really, really close to the all-time high there. Also not all-time high, the resistance there. Reversal days were also seen in the Eurostoxx 50 and FTSE, but not before both made new all-time highs, not panicking just yet. I was going to say that's a good point. Markets are still very, very close to all-time highs. Let's kind of, let's keep it in our pants, okay? It's not like the world's falling out of bed and we're down.
We're also still well within those ranges in that chart.
Oh, exactly.
Earlier in the week, I mean, the S&P has basically been in a 300-point range for the last 5 months now.
I was going to say, forgetting even the daily, but I was looking at a weekly chart yesterday for the S&P, and it's literally just gone sideways. So if you have been carved up in the past couple of months, probably down to you rather than the markets.
Yeah, you need to have a bit of a look at why that happened, I think.
Yeah, might be that you're over trading. But anyway, bonds, they rallied. Bund futures getting up to 129.07, then 129.12 overnight. 128.85 is now the Marubozu support. Whee. Dollar yen found buyers just ahead of support at 152.09. Bitcoin got down to 66,000, so looking good to retest the 58,000 and the 60,000 that we've been talking about for a long time now. Gold, the yellow metal, saw a sell-off to 4,900. But is recovering already. Silver took a bigger hit, down 12% on the day, selling off back to 74.37. We'll watch 79.57 today and 81.12.5 on the upside. It's already been rallying this morning, I saw just now. Copper, Dr. Copper joined in, is back below 13,030. Continuing the red theme, Brent and WTI crude benchmarks followed Wednesday's reversal candles with weakness yesterday. Henry Hub, we had some kind of IEA data that suggests more supply out there than originally thought, so that's weighed on markets. Henry Hub, which is US nat gas benchmark, another relatively moribund day yesterday. Good word that, yes, correct, Clive. And it's still south of Monday's gap. This side of the pond, in terms of gas markets, TTF gas, European benchmark gas, still confused with a lean towards the bears. EU carbon markets responded to the comments from MERS after hours on Wednesday with a big sell-off through yesterday, and it got through 76.10 and 73.86 on the way to the low of on the way to a low of 72. Power followed the carbon markets lower. German baseload, the calendar 27 contract, seeing weakness back to 78.87. On any recovery today, 80-10 is the level to watch. That's if you have access to the US power markets. Sorry, not US power markets, German power markets. Wheat was bid again all the way up to 553.4 to test the 200-day simple moving average. 544.5 is Marabou's support now, so I want to keep an eye on there. Yeah, that's it from Clive. Thank you very much.
Good stuff. Thank you, Ryan. Thank you, Clive. We'll get on to some of the slightly odd market. Oh, Clive's just said well done in a ever so slightly condescending manner.
I did feel, do you know what? I saw that, and I'm looking at Podbean as a recording, and I got the alert on my phone saying that's what he said, and I did feel like a virtual pat on my head.
I was just about to say it's a proper pat on the head, that one, isn't it?
And I was going to ask if he wanted to come into town join me for a pint later, but now he can fuck off.
Oh dear. We will get on to some of those market moves that we saw yesterday in a moment or two, but just in terms of catalysts on the day, they were relatively light, to be completely honest with you. Certainly data flow was lacking. We did get the weekly US jobless claims numbers. Initial claims at 227,000 in the week to the 7th of Feb, pretty much unchanged from the prior 231. Continuing claims at 1.862 million in the week prior to that, largely weather driven. And do note that neither of those prints pertains to the February non-farm payroll survey week, so they are, frankly, not overly important and remain at overall relatively subdued levels. There are a few bits and bobs on the trade front just worth mentioning. Of course, we had reporting on Wednesday via Bloomberg that the President Trump had reportedly been mulling whether to pull out of the US-MCA trade deal. Of course, this is due for renegotiation, which is set to begin in June. The White House trade advisor, Peter Navarro, was making similarly hawkish remarks on business television yesterday, noting that the trade agreement has what he called significant flaws and that Mexico and Canada are being used as staging areas for China. The reason why I bring this up is because I think we're going to hear a hell of a lot more of this sort of rhetoric over the next, 3 or 4 months, really, as we move towards those negotiations getting underway. The Trump administration seeking to build leverage on their side effectively for those talks.
So two things. Bear
that in mind.
Two things on this, and again, we did mention it yesterday, but worth saying again. One, we do love a good pull-out story on the Morning Blast. And two, escalate to de-escalate is his raison d'etre.
Exactly that. And that is exactly what we will see play out once again, you would expect. Maybe one day we'll get egg on our faces for saying that, but I don't think
not today.
Come anytime soon. And speaking of which, actually...
Oh, egg. Okay.
Yes, Matt, grow up. Speaking of escalating to de-escalate, the FT were reporting this morning that President Trump is planning to roll back some tariffs on metal and aluminium goods. So yet again, we see a bit of a reverse ferret going on. I think this also feeds into the narrative around the midterm elections, which are coming up later this year. Big focus on affordability around those midterms. And one of the easiest ways to improve that, or to inspire inflation to fall a little bit quicker, is to get rid of some of your tariffs. Trump also said yesterday that he reiterated he is going to be visiting China in April and that President Xi will visit the United States later this year. Of course, Politico reported earlier in the week that there could be as many as 4 meetings between those two as the year progresses. I absolutely cannot wait for that. Besides that, on a geopolitical footing, news out overnight that the US is sending a second aircraft carrier to the Middle East. The USS Gerald R. Ford, which was in the Middle East, it then got sent to the Caribbean. It's now being sent back to the Middle East to join the USS Abraham Lincoln. Of course, this is as tensions with Iran continue. Trump was saying yesterday that Iran has to make a deal, but if they don't, then we're ready to do something. Kind of a reiteration of the rhetoric that we've had for some time now. But do bear in mind that the US are continuing to amass forces within the region if they were to want to do something in the future. Sticking with the United States, Treasury Secretary Scott Bessent, he's apparently been speaking with Senate Republicans around the ongoing investigation into the Fed building renovations. Bessent has come up with the idea that he could take the investigation away from the Department of Justice and instead put the Senate Banking Committee in charge of things. This is basically as a way of trying to pacify some of the GOP senators, including Tom Tillis, who have said that they will not confirm anyone to the Fed board unless and until that DOJ investigation wraps up. I think it's a bit of a cynical ploy to say we'll carry on the investigation, but someone else will run it. Does that mean you'll drop your objections? But there we go. And just lastly from me, three things actually, two in the tech sector. Anthropic, they raised another 30 yards yesterday. That values the group at $350 billion. Amazon, meanwhile, they've had their Italian offices raided by the police. Apparently, this is some allegations of fiscal fraud, presumably the EU looking for another revenue stream through some fines. And last but by no means least, some news from the birthday girl, Rachel Reeves. It is her birthday today. She said yesterday, I have every confidence that the UK will beat economic forecasts in 2026. One, the forecasts are so utterly terrible that the bar is absolutely on the floor because the UK economy is not in particularly good shape at this moment. I only want to know why. Go and listen to the podcast yesterday where we did that in depth.
I did when I saw that yesterday, in my head immediately, I thought that was like me saying I could beat you in a 100-yard race. Because if anyone has seen Michael move, he moves like a 90-year-old man with bunions.
I will guarantee you that you would not beat me. And I can bring people to back that story up because we had this exact debate in the office and people were surprised at how rapid I was.
What was at the end of the 100 yards?
A pub.
Oh, there we go. There we go.
And do you want to know where the start of the race was?
A pub.
A different pub, yeah.
Well, obviously, it's not really the same pub. It might do a whole lap, maybe. Well, maybe there you go. Maybe we go to the Cross Keys and we do 3 laps at the bar.
God.
Right. So
what were we going to talk about?
What are we talking about today? Right.
Not me being Usain Bolt, that's for sure.
Yeah, well, true. Firstly, 2 things. We will talk about the CPI, obviously, coming up later today. Also, because of the market move yesterday, we thought we'd have a little natter about how markets don't owe you an explanation sometimes when there is a move. Now, there's been a lot of chatter about what the moves yesterday were about. Was it more AI disruption fears? For instance, we got that story of the karaoke company that it's good to see Tracy on the call because she put a good post out about it. And that's Chai Girl, obviously at Chai Girl. Everyone should be following her if you're not already. But it's a karaoke machine pivoted into trucking logistics and have apparently got AI to make this amazing, awesome trucking logistics tool that sent trucking stocks much lower due to fear that they're going to get overrun, disruptions from AI. Now,
I must admit, sorry, just on that, I was out for a beverage or 3 last night, and that story broke while I was in the pub, and I was like, "There's no way I've drunk that much."
No,
because it's just bizarre. This company's got a market cap of $6 million.
Yeah, with an M.
With an M. So this time last year they were flogging karaoke machines, and now you're trying to tell me that they're going to revolutionise the logistics industry. The other one, it's got bells on.
It's like, so I guess the question is, well, firstly, are markets that fearful that any headline about AI disruption can send all the chips off the table? I do not think so. But more importantly, and kind of zooming out a little bit, I think it is wise to point out that, narratives are shifting all the time, right? Headlines are coming out all the time. One of the worst things you can do as a new trader or even an experienced trader when you're just being a bit lazy is to see a move and then go searching for a narrative or searching for a specific headline to suit that move. Because, markets do not necessarily need a specific headline to go in a certain direction. And that's not just in terms of coming off, that's also going up as well. I think it's your pinned tweet, Michael. What's the narrative we're looking for today?
Yeah, it's also my Bloomberg bio as well, because it is worryingly accurate where, and the number of occasions where I don't want to sort of mock all financial journalists, but I'm going to indulge in a little bit of that now.
But he will.
Because, the number of days where, like a couple of weeks ago was a great example. On the Friday, it was stocks lower, gold lower because Kevin Walsh is nominated to the Fed. On the Monday, it's gold recovers as markets digest Kevin Walsh's nomination. Do you realise how fucking stupid you sound when you're writing stuff like that or saying stuff like that to clients? Another great example was this morning where we're talking with Clive on WhatsApp. What was driving the downside that we saw in silver yesterday? We traded, for those unaware, from about $84 an ounce down to a low just beneath $75 an ounce in the space of kind of half an hour or so. There was no particularly obvious catalyst. It didn't coincide with a data release or a headline or anything like that.
And as Clive just WhatsApped, something that gets him is that when there is no reason and we've, say, been sold off or whatever, the journalists and whatnot will throw out the quote unquote technical selling. Basically, it's just more sellers than buyers, but wearing a monocle whilst you say it. It's just, we do not have to find a specific reason sometimes, or a specific narrative, or a specific headline for for markets to go a certain direction. And the sooner people understand that, and the sooner that people understand that you do not have to write an article or write a blog post or write whatever because the market sold off and this is the reason why, the better. And also, as we keep saying, zoom out occasionally. Yeah, gold had a bit, or silver and precious metal had a bit of a move yesterday. But have you seen how volatile they are recently? It's all within the within the realms of feasibility. Like, these aren't outsized moves at this point.
No, and this is exactly it. People, and we say it quite a lot on the recording on the podcast, but people would be well served to just zoom out a little bit and get a bit of context. The headlines from yesterday: Nasdaq down 2% on the day. The bit that no one puts into those reports is and trades at a 4-day low.
Yeah,
it's not. It's again, we're in a relatively tight range. We're still in that range. Wake me up if we break outside of that range, then things might be a little bit more interesting and a bit spicier. But it's one of those where people get swept up in the excitement and the hysteria of what is frankly noise in terms of intraday market movement. And certainly when you see these sort of moves that have very little by way of a significant catalyst behind that, and we spoke about this last week actually on Friday. If you're bullish equities for whatever reason, 5 straight quarters of double-digit earnings growth, a solid US economy, whatever it might be, are you going to suddenly tear up that entire investment case because the S&P dropped less than 1% because of a karaoke maker bucking around with lorries? No. Whenever you do, then what are you doing?
And this comes into what this referred to as the catalyst trap. It's like newer trader specific, like I said, and this we have a lot of not, I wouldn't say novice, but maybe traders with not many years of experience, which we're glad are listening, because hopefully you add a bit of sense to the markets. Like, you see newer traders see a big red day and go hunting for either a headline themselves that they think can cause it, or look to someone else to tell them why it's come off. Now, and that's often a dangerous thing, because people which don't really know what they're talking about do all of a sudden build up this following where people assume that they are actually quite knowledgeable, which on social media is a lot rarer than you would think. But the problem is they'll find a catalyst or potential catalyst, such as like quote unquote AI disruption fears. Then they'll cement that in their mind and then assume that similar headlines the next day will always cause similar moves. Now, this is a completely wrong way about going back, because you might see the same headline on a different day and it could get completely ignored because it wasn't really the underlying catalyst of the day. Markets were perfectly happy with AI disruption as a bull thesis for 2 years. Now the same thesis is a bear thesis. I mean, this is how these things are changing. The real answer is often just positioning, or people were long, got nervous, started selling, triggered more selling. The narrative is the justification, not the cause. And I think that's a real, that's the difference you've got to make. What's the cause? What's the justification, etc.? They are sometimes two completely different things. Think of it like this. Headline is the excuse, not the reason. If the markets wanted to go up, they'd interpret the same news positively. That's something that people need to be aware of, in my opinion.
That's a very good way to frame it, actually. And I think just to finish up on this, that was really begrudging, wasn't it?
You and Clive virtually tapped me on the head today.
What was I going to say? Oh, yeah, going back to the AI thing, as you said, I think the other thing that's kind of getting lost is, whether it be logistics, whether it be insurance was a sector that everyone was talking about last week, software as a service the week before. You've got to remember that the customers of the companies that are involved here are major multinational firms. They are not going to suddenly turn around and go, do you know what? I've managed to build something on Claude in 5 minutes that's going to replace what Salesforce does with my CRM. That's not a commercially sound decision. There are also regulatory moats around a lot of what's going on here, particularly in the insurance space, which prevents any of the disruption from really taking place. So again, I think people are just making a bit of a mountain out of a molehill here, to be completely honest with you.
No, absolutely. Right, we've covered that. Looking ahead to today, obviously CPI, the main one. How do you want to do this? Do you want to do a brief overview of the day ahead and then we'll focus on CPI? Or do you want to focus on CPI first?
Let's do CPI first, because I've got a few things I wanted to mention on that one. So in terms of expectations, obviously this is January data. Headline CPI seen having risen by 0.3% on the month, which would be unchanged from the pace we saw in December, and by 2.5% on the year, which would be down from the 2.7 we saw in December. On a core basis, meanwhile, excluding food and energy, core CPI is seen rising by 0.3% on the month as well, and also by 2.5% on the year, which would be a cycle low if that core year-on-year print was realized. A few things worth bearing in mind in terms of the broader context around the inflation figures. I think firstly, it's worth bearing in mind that January is what we would call a noisy month for CPI. There's a lot that goes on at the start of the year, including the BLS recalculating all of their seasonal adjustment factors, which they do on an annual basis. And also, typically, companies will embark on a whole host of price hikes at the start of the year. That is just how things work. So whether we're actually able to extract particularly much signal from the numbers, I think, is a point for debate. Sticking with that, you've got to recall, of course, that the CPI numbers do still have a bit of a cool skew in them, for want of a better word, as a result of the assumptions that were made as part of the government shutdown last year, when the BLS assumed that prices didn't rise at all in the month of October 2025. The impact of that is still being felt in the data, which is actually skewing the headline metrics on an annual basis quite considerably lower than they otherwise would be. And I think the third thing to bear in mind is just the composition of the inflation figures that we get. And what I mean by that is, how do we see that split between goods and services? Because obviously goods prices could be skewed by tariffs. Services inflation tends to be a little bit more stubborn, a little bit stickier, and that's something the Fed are going to pay attention to.
So just on that, and I'm glad you said that, it's almost like we plan these things sometimes. It's like
we really don't.
I can't stress enough to our listeners how little planning goes into these. We decide what we're going to talk about 10 minutes before we go on air.
Yeah.
But regarding the details, and I think, again, looking under the hood, it really does matter. I have pulled up a little bit of research on this. When I say a bit of research, I kind of pulled out some quotes, etc. Housing and shelter. Michael has got the loudest keyboard on the planet.
Sorry, you'll have to blame Bloomberg for that. Their keyboards are not quiet.
Okay. Housing and shelter, still the stickiest component, was running at about 3% annually. If this doesn't budge, the core will stay elevated. That's the weighting of it. Regarding core goods, which Michael just alluded to, December was curiously low according to Natix. Economists expect to bounce as firms do beginning of year price resets, new supply contracts kicking in. The tariff pass-through, Goldman expects just only a 0.07 percentage points of contribution to core from tariffs, clothing, recreational household furnishings most exposed. Regarding energy, gasoline fell 0.5% seasonally adjusted in December. Nat gas was up 4.4%. So what January's energy component does, see what it does to the headline number. And also, but then we've got the seasonal factor update, right? BLS recalculates seasonal adjustments with the January release. So this could revise the last 5 years of data, which could quietly reshape the entire inflation trend narrative, because things are very finely placed. But yeah, there's a lot going on under the hood. Question for you, though, Michael, my dear friend. What's more important to the Fed right now? Jobs, inflation, or both?
I would argue jobs. I think the Fed have been pretty clear that they are leaning more into the employment side of the mandate. Powell was saying in January that risks are coming into balance, or they are slightly more balanced. But I think the Fed, if you think about the policy dynamic at the moment, basically the question we want to ask is, when are the Fed going to cut next, and what's going to force them into that cut? And I think right now, in the short term, if you're looking at the March and the April meetings in particular, they are much likely to pull the trigger on another cut at those meetings based on a soft labour market report than they are based on a soft CPI or PCE report, is the way I would be looking at things. I think they are more concerned about downside labour risks than they are anything on the inflation front. And I think market pricing reflects that. You've got about a 5% chance of a cut in March, 25% April, and the next cut is not fully discounted until July, at which point, of course, Kevin Walsh will have taken over.
Well, quite. And, funny enough, you mentioned that about repricing and stuff. And tying this back into our previous kind of little ratter? I meant natter, so I don't know why I said.
You sort of blurred it with rant, didn't you?
Yeah, it was. That's what. Okay, I'm coining that then. A ratter, a combination of a rant and a natter. In terms of why markets potentially may have sold off. Now, I'm surprised no one really kind of flew the flag that it was because of the jobs data on Wednesday, markets less likely, pricing in less likely chance of rate cuts, which bearish stocks, bearish risk assets.
Yeah, actually, that's a good point. I didn't see that narrative at all. That normally runs riot, doesn't it?
Good news is bad news for markets. Bad news is good news. When markets are screaming higher on bad data, everyone will say, bad news is good news for markets because Fed are cutting rates and it's going to be more money into the system. Well, we had really good comparatively jobs data than expected. Chance of a rate cut was dropped. So, bearish for risk assets makes perfect sense. But, no one was flying that flag yesterday. Maybe I should start doing it today. But anyway.
Yeah, maybe. Anyway, in terms of other bits and bobs for the day ahead, to be completely honest with you, there isn't too much on the calendar. 10 o'clock this morning, we get the second estimate of Q4 GDP out of the Eurozone. The Eurozone economy set to grow by 0.3% on a quarter-on-quarter basis. That will be unrevised from the flash estimate that we had a couple of weeks ago. We're also due to hear from the ECB Vice President De Guindos, as well as the BOE Chief Economist Hugh Pill throughout the day today. And it is a pretty light one in terms of corporate earnings, the only notable report coming from Moderna before the market open. The other thing just worth flagging is, as always, be aware for the potential of any gapping risk over the weekend, particularly as tensions continue to simmer away in the Middle East. And also just bear in mind, in terms of trading conditions more broadly, they could become somewhat like my hair in relatively short order, aka very thin. The reason I say this is because, of course, it is a long weekend in the United States. It is President's Day on Monday, so the Yanks will be away. It's also worth bearing in mind that we are just on the cusp of the Chinese New Year, or I think Lunar New Year, as you're meant to call it these days. So a lot of Asia centres are going to be having multi-day holidays over the next week or so. I think China is shut for the next 9 days. If you're trading anything in APAC, obviously go and look at the trading hours for the product you're looking at. But I think just more broadly, it's worth bearing in mind that over the next week or so, certainly overnight, for those of us here in London, participation in financial markets is going to be considerably less or considerably lower than it tends to be in normal times. So do just bear that in mind, particularly in terms of metals, because we have seen some rather odd moves in the metal space in APAC trade recently. And obviously, if liquidity is thinner than usual, that's certainly not going to help that situation. So one to keep in the back of your mind as we move into the next week. But that is all from me this morning.
Wonderful. Are you work from home today, Michael?
I am indeed, yes.
Oh, boo. Well, I'm seeing you for beers tomorrow anyway for the rugby. There we go.
Oh, are you there? Oh, perfect.
I'm in the WhatsApp group. You can.
Well, I'm not, and I've still got invites. So.
Okay. Oh God. Quick. Abort. Right. Anyway, me and Michael can sort out our social lives off on a different recording.
Well, no, we're not doing that on a recording.
No, definitely not. Listeners, we hope you've had a great week and a profitable week. Hope you have a fantastic weekend. Hopefully we've added a smile or two to your week and a bit of value to your day.